Joining us right now with more on the markets is Emily Roland. She is co-chief investment strategist at John Hancock Investment Management. And so I guess the immediate question, Emily, is what do you anticipate coming from the PPI, and what do you think the market's reaction will be if the number's hotter than expected?
A market moving number. I would point to the response to the CPI report yesterday that was pretty notable. There was a pretty sharp move initially, and then equity markets really started to take it in stride. We saw that back up in bond yields calm down a little bit. There's been this almost asymmetric response to inflation, where as it came in hotter, markets pretty much shrugged it off. There may have been some pricing in of this before the report, given the potential for tariffs to be inflationary. But think back to last month. Inflation data came in softer by a rounding error, 0.002%, and markets loved it. We saw bond yields fall, risk assets rally. So it's almost like markets are expecting higher inflation here, but any relief from a softer inflation print is going to cause bigger moves. So that's what we'll be watching with that PPI report this morning.
Oh, that's interesting. You think the bigger move would be if it was a softer number, that the markets would then do what? Skyrocket? At least equity markets?
Yeah. I think because of the sensitivity to bond yields, you'd see bond yields falling, and then you'd see equity markets responding positively to that.
Okay, that's a good thesis and something to watch for. We do have commentary from President Trump on Truth Social this morning, just that the retaliatory tariffs are coming, that today is the day. I guess we'll hear some more information later, get more details on this. How have you been thinking about that? How have you been factoring that into your expectations for the market this year?
Yeah, we don't make tactical moves based on potential political outcomes. It's really hard to do that. It's tough to handicap it, and things can turn on you really, really quickly here. So we're trying to be thoughtful. We're trying to be thinking longer term, and we're thinking about earnings. The macro has been, and the political backdrop have been taking center stage, but one of the most underappreciated things going on is S&P 500 earnings. We're coming in at 16% year-over-year growth for the fourth quarter, and the great news is it's broad-based. It's not just technology companies. We're seeing areas like healthcare and utility stocks seeing double-digit earnings growth, financials up 50%. So the earnings engine in the United States is on right now, and that's very positive. What we are seeing, though, is this massive capital migration into European equities. It's momentum, it's potential algorithm driven. We're seeing big price moves in Europe, even though the economic and earnings data aren't that great there. So we would resist leaning into those lower quality parts of the market. That is the trade to start 2025 and redeploy assets into U.S. markets where we are seeing better relative earnings and better relative economic growth.
I like that approach. Kind of keep your head down, keep the blinders on, and focus on what's really coming out from the companies themselves. When you do that, what are the most attractive areas in the market? What do you like the most?
Yeah, so we're continuing to look at areas like healthcare in the United States, which are now that sector's trading, Becky, at a 20% discount to the broad market. It's got great quality characteristics, elevated return on equity, great balance sheets, lots of cash. Healthcare notably tends to outperform in the first year of a Republican administration as well. Part of that is because analysts price in the potential negative impact to earnings early on, and then that worst case scenario does not materialize. So that's one of our favorite sectors. Industrial companies in the United States, we think if you want to look to add cyclicality to portfolios, they continue to benefit from onshoring activity, supply chains coming back to the United States, and the manufacturing renaissance that we continue to see in the U.S.
Okay, but I get your approach of just look at where the numbers are coming from, but then you said every reason that you like these sectors are because of what's happening in Washington, too. So I guess it's hard to not focus on what's coming out of Washington no matter what.
Fair enough, fair enough. You've got to consider that, I think, at the margin. But I think, like, thinking about every phone call that happens in D.C. and trading on that, I think, is a strategy that's really tough. The tariffs are a perfect example. Last week, putting hours into putting together a piece for investors to use to think about modeling the tariffs on Canada and Mexico, and then, 6 hours later having that be moot. So I think it's challenging on the shorter term, for sure.
Right.